Namaskar and welcome to this very special Diwali edition of Market Masters. I am Sakshi Batra and with me is my colleague Shalpat Nagar. Now as the markets are now finally lighting up and showing up the festive cheer and investors are now looking to usher into this new Samvat with prosperity and some promise, we're going to be decoding for you on this show what really lies ahead for your wealth journey in the new Samvat year. What we've seen this year is that gold and silver have continued to sparkle. There's been a lot of buzz around equities as well, from policy tailwinds to even global headwinds. We're going to be now bringing you insights from the sharpest minds on the Lal Street. So as you light that first diya this Diwali, you should stay tuned in because this special festive episode, we're going to be getting you the next biggest opportunities that you should be looking forward to as well. Let's welcome the brightest minds on D Street on the program. Mr. Mihir Vora, the Chief Investment Officer of Trust Mutual Fund, is with us. We also have with us Mr. Jyotivardhan Jaipuria, the founder and MD of Valentis Advisors, and we are also joined by Nischal Maheshwari, market expert and a legendary investor there. Warm welcome to all of you and happy Diwali.
Happy Diwali.
Thank you. Same to you. Happy Diwali.
Let's start this conversation with Mihir. Namaste Mihir ji and a very warm welcome. As Trust Mutual Fund grows both in terms of number of funds launched as also the asset under management, what are the 2 or 3 things that you are looking forward to Samvat 2082 against the backdrop of a completely flat equity table in the last 15 months and a lot of effort that the government has put in to boost economy, sentiment and stocks?
Absolutely. So first of all, viewers, a very happy Diwali and season's greetings.
Thank you.
The good thing, as you mentioned, is that I always look at the glass as being half full. And the half full part is that we've delivered flat returns for the year, which means that our valuation base, our price base, momentum base has been reset, so to say. So after almost 4 glorious years in the market, if we have to take 1 year as a breather, I think that's fine, I guess, in the longer term scheme of things. So we have a situation where, of course, earnings have grown, though not at very high rates, but at least at high single digits for the Nifty and higher for the Midcap and Smallcap indices. So there has been a valuation correction, there has been a time correction in the market. So compared to 1 year ago, valuations are not as expensive because of the time correction and 1 year of earnings having accumulated. So that's a good place to start with. If you look at the fundamentals in the macro picture, there are tailwinds mostly from the local side, but there are headwinds from the global side. Global headwinds, we know the tariff negotiations with Trump. We know the overall situation where inflation probably might start rearing its head, and of course the situation in Ukraine, China, etc. continues as is. So I think there is a good chance of the US economy and the Western world slowing down this year. But again, that the policy framework as far as liquidity is concerned, monetary policy is concerned globally, is turning loose. So we have a situation where there will be ample liquidity, there will be enough cutting of interest rates to keep risk assets up globally. So that's a global headwind which might actually turn into a liquidity tailwind for assets like gold, silver and even in emerging markets like India. Domestically, I think the government and the RBI are in a, I would say, whatever it takes mode. They very clearly said that whatever global headwind is there, we will take enough and more measures to counter those. And we have seen that in spite of intense pressure from the US, India has stood its ground on negotiations. India has not compromised on its pride or its policy framework. So to that extent, I think the message is going through very clearly to the world that India is a strong country, India is a domestic economy, and while exports are required for higher growth, we are not overly dependent on exports for our overall well-being. So I think the image of India in the last 6 months has gotten reinforced as a strong, independent, democratic country with transparency and institutional frameworks. So I think that's going to, stand us in good stead for the rest of the year, for the very long term also. And I think it's only a question of time before we see FIs turning net buyers, apart from the domestic investors who are anyway massive buyers every month. So I think we are starting with a good time and price correction and a good base to start with, and I'm optimistic as we begin the new year.
Okay, Jyotivardhan ji, I'll now come to you, and I want to begin by first asking you, what was more disappointing this year? Not having the Nifty see handsome returns and giving flattish returns, or having missed out on the gold and the silver rally?
It was, we didn't miss out as much because my wife has enough gold and silver. But the disappointing was that she's a much better investor than I am. And she doesn't spend time on investing also. So for her, it was like, after spending 24/7 doing nothing else, you still can't make money. So, on a lighter note, that was. So I'm hoping next year, will be different. We'll do better in equities than we do in gold and silver. And so, I think, what will probably change, and this is what I'm hoping, and I think Muse was alluding to this. So I think FIs will be more positively inclined to India over the next 1 year than they've been in the last 18, 24 months. So I think, three things will drive this really. One is the positioning. So today, India is the most underweight market for emerging market investors. They are underweight by roughly 2.5%. So at some point, the positioning is such that on any positive news, we probably see FIs buying. Second is India's underperformed massively. So last 1 year or year to date, India's amongst the worst performing markets in the world. And this is all like a year ago. This was all different. India was a great market. Third is valuations. So valuations are not as cheap as we would like it to be. At the same time, they've gone to reasonable levels on a very relative basis to emerging markets. So today, if we see India trades at a premium of like 65% to emerging markets on a PE basis, if you see a long-term average, this has been somewhere in that range. It's been around 60%. At a peak, India was at like 120% premium to emerging markets. So in some sense, because India has underperformed a lot versus China and a lot of the other emerging markets, relative valuations have become good. So from here, if we get some positive news, then you probably see FIs trying to at least cut their positions. Now, this could be, it could mean that lesser selling in India than other emerging markets, or if the Fed keeps cutting and then we start seeing flows to emerging markets become very positive, then it will be a positive flow. So I think, what will really make them turn, hopefully one is earnings pick up. So I think September will show some signs, but from December, I'm looking at double-digit earnings growth coming. And we've had 6 quarters, just remember, with a single-digit earning growth. So that will be a help. And I'm not counting on it, but if at some point we end up with some trade deal with the US, at least, that 25% extra reciprocal tariffs go up, that could be like a sentimental positive, at least for FIs.
Right. Mr. Jaipuria, what an honest confession. I'm sure a lot of peer group fund managers are also grappling with the same issue back home, as is everybody. You can just see the smile on Sakshi's face, how wonderful it feels to her that how the world has turned out.
All thanks to my parents. I have not bought any gold or silver myself. I've only inherited whatever I have. So thanks to my parents that they did most of this
heavy lifting
themselves. Yeah.
चलिए निश्चल जी से बात करते हैं. महेश्वरी साहब, the job of a quality stock picker such as you is to avoid the noise in the market and go for potential gainers in the market. So what has been your main learning for 2025? The 10 months have passed, and of course a couple of months from September 2024. And to you, does the overall investing universe of quality stocks now look a little more attractive than what it was 1 year ago?
Good afternoon, Sakshi and Shell. Thanks for having me. And a very warm Diwali greetings to yourself and as well as your viewers. So I think a few learnings from 2025. I think one is very clearly basically that whatever you are expecting may not turn out to be right. So we were the first guys basically on the street or with the US who was expecting a deal to happen. And a favorable deal to happen, basically. And we have seen the consequences of that. So I think do not expect the expected to happen. And that is going to actually keep you a bit more safer in this market. So that is the first learning, basically, which one should take away. And second thing is, I think given this current year has been a sort of a flat market. But I think a lot of earnings basically which were supposed to be delivered didn't come through. And that's why you've seen basically a lot of disappointment in the current year. And I think a good third point could be basically that if you expect that the market is going to continuously deliver last 3 years what it did, basically I think that's not going to happen, because market is more of it's not a linear place. Basically, if you are investing into equities, you have to be clear, or you have to be there. Basically, there will be ups and downs. So I think current year one should take it in its stride. Uh, and I think another fourth point is, I think valuation is the most important thing at the end of the day, basically, because not everything can be bought at any valuation. So I think there are 3 or 4 learnings basically which I have from the last year.
Okay. Mihirji, coming to you, I want to understand if you could help any fresh investor who is now holding on to some cash and was probably just waiting for opportunities to enter and the markets did not give him. At the start of this new Samvat, what are the top mutual fund categories that you would want him to or her to invest in the new Samvat?
Sure. So for a starter, I would say the flexi cap or multi cap category is a good place to start if you don't have exposure at all. But if you already have good exposure and are looking to kind of add spice to the portfolio, or even do a more strategic allocation, I think small caps and mid caps are the space to be. Because the sheer number of new segments opening up in the country all the time, the sheer number of entrepreneurial candidates I can see when I meet companies is mostly in the small cap space. Just to give an example, there are 100 large caps, 150 mid caps, but in my opinion, after the 150 mid caps, there is at least 600 to 800 stocks where we can do some good stock picking as far as growth investing is concerned. So for a country like India, you want to be a growth investor because India is the fastest growing large economy in the world. We generally are a younger population. So the longer term prospect of India is basically in growth investing. And the highest growth typically we find in pockets of small caps. So I would say that, if you already have some exposure to equities, the incremental exposure can definitely be in the small and mid cap categories.
Getting Mr. Jaipuria into the conversation. Sir, at this point of time, there are 4 major tailwinds for the markets. An income tax cut, RBI increasing liquidity and reducing interest rates, and of course the GST cut followed by a good monsoon. While most of this has played out in stock markets via autos, via the consumer goods theme, what according to you are spaces where still fund managers such as you can go hunting happily?
Yes, Shell. So, a lot of these, I guess everybody knows this is in an attempt to help the consumer. Because what we've seen over the last few years is the government did a lot in terms of the capex theme. And, they have practically doubled their capital expenditure as a percentage of GDP. So now, this year the focus has all been on how do we increase consumption spend. Like you mentioned, some of those are obviously ways to play the consumer, whether it's the autos, whether it's, the consumer. And I think more than the staples is the consumer discretionary we want to focus on. In the discretionary, there are other spaces like, probably travel and tourism, which are going to play out. One other segment which probably is now looking attractive is the banking space. So, as like you said, interest rates have come down, so people will borrow more from the banks. The banks faced like a pressure because of NIMs were down because rates were coming down. And, probably the September quarter will reflect that also. But going into the December quarter and the next year, I think, we'll have the reverse impact of that where actually NIMs start to move up. Second is if you think of the banks, the valuations in banks are cheap. It is one of the few sectors where current valuations are lower than what the 10-year average valuations are. So banks would be one way to play, both the consumer theme and, probably private sector capex which starts to come in. And that's one segment we are focusing on just now.
Okay. Let me go to Nischal ji now. Nischal ji, help me understand. This year, of course, we had one more missing factor, and that was the FIIs. Of course, the markets did not miss them that much because the DIIs were constantly supporting the market sentiments and, in fact, buying more aggressively. Do you see the FIIs returning to D Street in the new Samvat? Are there enough triggers to bring them back? And even if they don't, do you think the markets will have a good year despite their absence too?
So I think there are enough triggers. Basically, if we really look at the broader economy, I think earlier Mihir had anyway alluded, saying all these factors basically which are going to actually line up in the current year. So I think second half of the current year, the earnings are going to be better. Interest rate cuts across India as well as abroad. I think this is going to create more liquidity. So I'm very sure in the relative valuation. So I think China has run up quite a bit and India has underperformed. So I think there are 2 or 3 of these main factors basically which are going to help. But will it happen immediately? I don't think so. I think basically it will take another quarter for us to actually start things or start these things settling out. I think the first one big factor is basically the China-US settlement of the tariffs. I think that is creating a huge amount of uncertainty across the world. If you really look at it at the moment, the Indian CFO, CEO confidence is at the lowest in the last 6 years. So I think I'm just telling you about the Indian side, but I think it may be true for the international market also because of these tariffs. So we need to get these things out of the place basically before we believe that the FIs are going to come back into the market. So maybe another quarter or 2 basically is what I see. But definitely I think India is a good market barring valuations. I still believe basically we are not in a good territory as far as valuations are concerned.
I think that's much to do with this 29,000 crores, 25,000 crore rupees SIP money coming each month. I'm sure there's a crisis of plenty at Mihir's end. He has so much of SIPs coming in that he has to invest. Otherwise, no investor will give you money to stay in cash. Which Mihir brings me to my next question. Despite the correction in price, despite valuations also easing a bit, what are the sectors that you are not touching at all?
There are very few sectors where we would say that we will be zero in. But in general, I am still underweight on IT services basically, because I do believe that the best is over as far as the tech spending on the services part of it is concerned. Most of the tech spending is happening in the AI space and the buzz space, where India still is not a big player. So in India, we'd rather play through some data center or those kind of place. But IT plain vanilla services are not a place that we are very excited on. Second is the regulated utilities, etc. Those are the spaces where again not very exciting. We are growth investors. We don't really like 8, 10, 11% growth. We want to be in pockets with at least 15 to 20% growth. So the low growth utility space is something that we are underweight on. And while recently there has been a pull up in commodities like metals, steel, etc., I would still be underweight generally in commodities and oil, etc., energy pack, because of the fact that we are going to see renewables coming in a big way, and second, the world economy is likely to slow down a bit. So the global plays are places where we are underweight on and negative on, and the domestic plays are basically where we are there.
Okay. Jyotivardhan ji, could you help us understand if there are any pockets that you would still want to stay away from even in the new Samvat? What would those pockets be?
Yes, some things which we are staying away currently, like, which is very similar to me, we are staying away from IT. And we've been staying away for quite a long time now. So we're not really, in fact, I've bought a bit of IT, but we're still underweight IT. We are, getting more positive on cement, which we were underweight on earlier. One segment we are staying away, which sounds a bit consensus, consumer staples. So, we like the consumer story, but our thing is played through the discretionary. The consumer staples is still going to be a space which will grow much slower than the discretionary, and valuations are very, very expensive. So those are things, and the other thing is we've stayed away generally from all these oil companies.
Okay. Nishalji, let me bring out the contrarian stock picker in you, and it's to IT. Software presents a wonderful opportunity with debt-free companies, huge cash flows, dollar income for the patient and the long-term investor. According to your valuation matrix, where does software slash IT stand at this point of time? Traditional IT.
So I think basically, if we really look at it, the earnings growth to valuation, I don't. I agree with both Mihir and Jyoti. It doesn't make sense basically because the PEGs are like whatever, maybe 1.5 or whatever kind of numbers basically, much higher than because the growth is I think 5-7% basically, and they are still all quoting 20 times plus. So there is no logic for that except for a few stocks like Persistence done results are very good, go forth. I mean, some of these stocks basically might still do well. But I totally agree with both of them on a broader sense. It doesn't make sense basically to hold much of IT. Now we have to go back and look at it one space which is maybe IT, but I think domestic IT e-commerce space. I think that is one basically which is really interesting. The platform spaces are really interesting. Now, obviously, I think the valuations are totally, I'm saying most of these guys don't have a earning. So valuations are, you cannot really know basically what kind of valuation. But what we have to give to them basically when they 4 or 5 years back, when they came to the market, they were being funded by private equities, and there I think they were, the thought process was basically to create a market rather than actually focus on profitability. But as soon as they got listed, I think all of them understood the game, and I think all of them slowly are coming to profitability. So I think that is one big space basically within the country. I think platforms, and I own quite a bit of them basically. So just a disclosure. That is one space basically within IT. If you consider that as an IT, is where I would put my money and continue to recommend it.
Okay. Let me also come to Mihirji again. And Mihirji, could you help me understand when it comes to the key themes like banks, for instance, have been an outperformer this year. Nifty Bank managed a double-digit gain, whereas the other major indices were still flat. Large private sector banks drove most of the recovery. There's a lot of buzz now on the PSU Banks demerger and merger consolidation, and how the government will be stepping in. How are you looking at that as a trigger? Do you think in the new Samvat it's PSU banks that could come back into flavor?
Sure. I think both PSU as well as private sector banks are very attractive in terms of valuations. As Jyoti briefly described, the only reason why some of these banks, or most of these banks underperformed for almost a year and a half is basically because of two reasons. One is credit growth was not coming through. Then in the initial part of the rate cut cycle, which is what we are going through, there would be a short-term compression in margins, which we have seen in some of the banks, most of the banks, I would say. And third is last year and early this year, the RBI also came down quite heavily on some of the NBFCs and banks as far as some of the pockets of lending were concerned. So overall credit slowdown and some margin issues kept the banks, under pressure for quite some time. But after underperforming for almost 1.5 years, they are now one of the best pockets of value, I would say. And where the only trigger now missing is credit growth, and which, as we all believe, in the second half, if the economy is likely to do better than the first half, then I think banks should be one of the sectors to lead. And within that, as you mentioned, the PSU bank space is of course offering higher value in terms of cheapness, etc. And now I think the differential in growth between the PSU banks and private sector banks is less than before. Earlier, you used to have private sector banks growing at 25-30%, PSU banks growing at 10 to 15%. So the differential was quite large. But now you see even PSU banks growing at similar rates, both are growing at between 10 to 12%, which means that even the growth differential is not as attractive as before. So you might see PSU banks perform in line with the private banks, at least for the shorter term, though in the longer term, I still believe that the private sector banks will grow faster.
Okay. Mr. Jaipuria, mostly fund managers bet on quality stocks showing strong growth patterns both in earnings as well as stock price. To your mind, this India internet space, is it alive and ticking in terms of earnings growth overall? I mean, we have platform companies, we have companies that sell and buy cars online. You have many online payment aggregators, and the IPO pipeline is also full of such companies for 2026. What is the valuation metric that you put in mind when you look at the India internet space?
Yeah, Shell. So it's a very tough thing, especially for people like us who are very value conscious. So with all these platforms, the good thing is you will see a lot of probably growth over the next few years. Just change in consumer buying habits, and so more and more things will move to the platform. Second is it's a winner take model. So there'll be a few of them who will be winners who will do very well, and there are a lot of others who will struggle because a lot of them work on a scenario where if they are making losses today, somebody will keep funding them. So if you get a funding winter at some point, then many of these companies could get bankrupt or go shut down. So that is the other thing which we have to keep in mind, that can they sustain if somebody does not fund them at some point. And third is, like you said, the valuations are very tough for us to do. So that is why we end up not owning too many of them, because we like them on a 3-year, 5-year basis in terms of where they'll be, and there'll be a bigger share of the market. But in terms of pure valuation, you just think there's too much priced in or too much optimism. We'd rather wait and see where they deliver.
Coming to you for the new festive season and the new Samvat as well, if you could help all our viewers understand what is going to be a winning portfolio and what's going to be the secret behind it. How do you generate alpha in a world which is so seen as a VUCA world, completely drawn by a lot of uncertainties that we see on an everyday basis, and you do not know what's going to be coming in next. So how do you create a winning portfolio amidst all of these uncertainties, sir?
Is this for me?
Yes, Nischalji.
So I think one thing is basically in this kind of a scenario where there is so much uncertainty, one should be a long-term investor in this. Basically, I think that is where a 3 to 5 year horizon, I think that's a fair way to start playing this. And given that India is a fairly regulated economy, I would say basically wherever the government is pointing, that's where the investment should go. Basically, if we really look at in the last 5 years, the sectors which have done really well is basically where the government is come back, or government is the policies are favoring that. So whether it was solar, whether it was defense, I think some of these best industries have been government focused industries. So whether it was used to be capex, so earlier it used to be capex, so basically it was all government focused. So wherever the government policy and focus is going to be there, that is where I think one should invest, and the sectors which are surrounding it. So in case of another sector which comes to mind is semiconductors, where the government is now focusing very hugely. So now we have to look at it saying, okay, there are not many plays, but is there something basically which one can figure out, saying that industry which is supporting the semiconductor. Now, power is one of that basically. That's a major requirement of a semiconductor industry. So I'm saying that's a way basically to play. So focus on where the government is focusing or where the government policies are focusing. And that's where I think on a 3 to 5 year horizon, one can build up a portfolio in this kind of uncertain times.
Okay. Ladies and gentlemen, the final question goes to Mr. Jaipuria. Sir, a view on the bond market, the rupee and interest rates.
So, I think interest rates probably have some more cuts which we'll see. Not too many of them, because RBI has been hinting that they are done with it, they front loaded it. But because we see a cut coming in the Fed, and Fed could have like a series of cuts, we think there's some space for RBI to cut. So I think we'll probably see a 25 to 50 basis point cut in interest rates, which will, mean that bond yields could go down a bit more.
Okay. Mihir ji, last question to you also. What is that one wish that you will go with into the new Samvat? What do you don't want to see repeat of 2025, 2026 into the new year, sir?
I just don't want to see too many more tweets from Trump.
Trump. That's a fantastic one.
That's a good one. That's a good one. Yes.
I don't think any one of us would want to see any more tweets.
I think a lot of people, Sakshi, I'll tell you a very interesting conversation which I had once with Mr. Druckenmiller. He's a very well-known fund manager, about the same thing that Mihir spoke about. But ladies and gentlemen, time to wrap this all. And thank you to all our gentlemen here, Mihir, Jyotivardhan sir, and of course Mr. Maheshwari. Here's wishing you, everyone at home, and all clients and all customers the best that the new Samvat has to offer. And let's hope gold doubles from here, so does silver, and equities go 4 times up in the coming 12 months. That will balance everything out.
Thank you.
Thank you so much. All right, viewers, with that, we wrap up this special conversation. But Diwali special conversations with top market masters continue in the run-up to Diwali. So stay tuned with us on Business Today. There's lots more for you to catch up on. Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is our festive special conversation. It's been an unprecedented rally for gold and silver thus far, and all eyes are now on finding out what really comes in next for these precious